So today we're going to talk about business financials. It's going to be one of the shortest one, but it's the one that gets me the most problem. So, all right, a little bit about myself. My name is Carlos O'Neill. I work with Achieva Credit Union. I've been with the credit union for, it's going 7 months actually. But previously to Achieva, I worked for Bank of America. I did commercial banking for about 18 years. So I did anything that has to do with lines of credit, owner-occupied real estate, working capital, business acquisitions, SBA, 7(a) and 504s, anything that you could think of that a commercial business will need for expansion or to grow the business or to start the business. I've seen it all and I've done it all. A little bit about Achieva. I guess if you could see at the bottom, Achieva was established in 1937 as a Pinellas County teacher credit union. And they started with $99.25, and now look what we are. We owe a little bit over $1 billion in assets, and still growing. So basically, what we're going to go through today, it will be around the financial package, which is known as a P&L and balance sheet for a business. Once these things start working with me once again. So we're going to go over the balance sheet, income statement, cash flow statement, and financial analysis. Balance sheet is basically gives you a synopsis of the business assets, and that will be, including what liability comes with it and the equity that the owner and the business has towards the assets. There's two different type of assets: current and non-current. Current will be, whatever cash you have on your checking account, any receivables that you are able to collect within 90 to 120 days, and inventory that you could turn around and sell it within 90 days to 120 days. Non-current will be property and equipment, so that would be if you have a brick and mortar business, those are long-term assets, as well as the equipment that you utilize to produce your product. Current assets, as I said, is your account. No, this is your liabilities. I'm sorry. It will be your accounts payable, whatever bills, whatever merchant or whoever you work with that you get your raw material from. That's part of the accounts payable. Short-term debt. Short-term debt will be, I'm ordering a bulk of supply, raw supply from China. They giving me 90 days to 120 days for me to pay it off. That's considered that, as well as I have a line of credit that I'm going to use to purchase this raw material. It's going to go, you have a period of time for you to pay us that debt, which is around 12 months. Long-term debt, that means loans or any bonds that you have with the business. And loans, we're talking about term loans. Anything that is more than 12 months, that is going to take you more than 12 months to pay it off, those are your long-term loans that you have on the business or debt for the business. Owner investment, retained earning. This is one thing that a lot of the clients or members don't have a very good understanding of it. If you're showing a positive on a retaining earnings, that meaning that the business is doing great and that the business is able to stand on its own. I have just a specific example. I have a prospect. She wanted to buy a spot in Tampa. The spot gross revenue was around $950,000 a year. Their cost of goods was around $500,000. They only had 3 employees. I want to work that. I don't know why. But at the end of the day, they wanted to sell the business for $350,000. When I started looking at the financials, They had about $50,000 in negative return earnings. They had a negative net profit the previous year, and they only had about $75,000 in inventory. What the inventory was, we have no idea. So I asked the prospect, how did they came up with the number of 350,000? If we try to do a financing on this business, we're going to look at, the big picture. Right now, the business is only showing that it's worth 75,000 because of the inventory that they had. But she didn't understand that. So I ended up explaining to her, first of all, the business looked like it's not making any money. The owner's taking all the money at the end of the year, and it's leaving the business in a negative position. After I explained to her the whole picture of why, even if we take it to the SBA and they look at it, to them it's gonna be an automatic decline as soon as they see that on their table. So I ended up explaining it to her that anywhere that she goes to, if these numbers look the way that they look, unless she has cash available in her bank to buy that business, that will be the only way that she's gonna be able to do it. So always, I always tell the client, don't take all the cash out of the business because it's not healthy for the business. It's not healthy for any future lending. The income statement is going to give you information about the revenue, the expenses, and that, subtracting the expenses from the revenue is going to give you your net profit, your net income. What's the bottom line? That's the one thing that the most of the financial institution will look like, because they want to make sure that you're able to pay that debt back to them. They don't want to put you in a situation that a year to 2 years down the line, you're not able to pay that debt. So we're going to have to either take the property back or you're going to end up defaulting on the loan. The cash flow statement is just a movement of cash going in and out of the business. Basically wanting to, we want to know how money comes into the business, how you collect your funds, and how money is going out of your business. What kind of bills or what kind of loans do you have out there that your money's going out to? One thing that I always tell my client, the profit and loss and balance sheet, you could always review those documents at any point in the business cycle throughout the year. And it could tell you how good the business is going or how bad the business is going. One thing that I always tell my members, when you're looking for lending, there is a formula that the bank looks like. And that formula is that the business, to me, you have to be making at least $1.25 up to $1.35 for every dollar that you borrow. That is the global, that is the coverage ratio that the bank will look like. And the way that you could find out if you are at that mark, you want to take your current assets and you divide it by your current liabilities. That's going to give you that percentage, whether you are there, you over it, or you're not there. And then like that, you could take a look at your operations and be able to make any necessary changes that you need to make to be able to get to that number. Operation activities. So basically the cash movement, it goes, to your operating the business, if you invest in the money, and what kind of loans, finances you have on the business. That's just basically how the report will show how money goes in and out of the business. Where's it going? Who's getting the money and all that. This one, I don't see this much unless a member is trying to purchase, do a business acquisition, changing of equity, meaning if you have someone that wants to invest or wants to become a partner into your business, this is where it's going to come in place. We want to know where what's the individual background, what do they bring to the business? Are they bringing any investment or any money into the business, or are they just becoming owners to the business just because they have nothing else to do. The financial statement, or as known as P&L and balance sheet, is very important for the simple fact that, it supports us as banker. We take a look at that to make sure that the business is able to take more debt. It'll provide out transparency to your investors if you're looking to acquire more investors into your business. And basically, it's required by law. I mean, you want to be able to provide this type of report whenever either you have an audit or, the bank, you have a loan with the bank and the bank wants to see how the business has been performing. Most of the loans that we do at the credit union, anything that I believe that is above $1 million, we have to do an annual review on their financial just to make sure that the business is still strong, still making money, and we don't see that it's going to be a problem down the line. Financial statement analysis, it's the same thing. How liquid is your business? How profitable is your business? Efficiency on your business and solvency. The more liquid that your business is, the easier that it's going to make for any bank to give you any funding. Because at the end of the day, they see that we have a lot of members out there that they're very liquid, but they don't want to use their money. They want to use the bank's money, even though that they know that they're going to pay interest on it. But that's what makes the business stay strong, because of how much liquidity they have available, even though they have loans out there that they owe to other banks. But, it's a smart thing to do, because at the end of the day, they earning some type of interest on whatever funds that they have sitting on a money market while they paying, pennies to the dollar on whatever rate. But even though the rate for any loans is going to be a little higher than a savings account, but at the end of the day, it kind of balanced them out on both. Some inconsistency or red flags that I have seen myself on those financials is missing data. Business has a lot of debt. Revenue has been declining. Negative cash flow over multiple period of time, and spiking expenses or revenue. This right here, expenses is understandable. Of course, you're going to acquire more expenses the more you grow in your business. Revenue, at times, is a little bit concerning depending on how extensive the revenue goes up. So if a member or a client is making $900,000 the past 3 years, and all of a sudden it goes up to $2 million, the bank wants to know what happened. Why did that, substantial increase in revenue? Is it a one-time thing? Is it something that is going to stay steady and it's going to keep growing? Or it's just because of the way that the economy was at that point in time. So, you as the business owner will have to be prepared to be able to explain that, because if it is a one-time thing, we're going to base it on what the previous track record is on that $900,000 that the business has been making. If it's something that, you got a bid contract that is going to last you 2 to 3 years for you to, finish that contract, then that's something that is going to happen in the next 2 to 3 years. So the revenue is going to stay at the $2 million or more. Declining in revenue, what's happening? I mean, is it because you have too much debt? Is it because your clients are not paying you in time? Is it because you lost contract? One thing that I always tell my members is, depending on who it is or what it is, try not to concentrate or have a higher concentration on one particular customer. And the same thing goes with any vendor. Because at the end of the day, if that customer, if you have 25% of your revenue coming from one client, what if that client wakes up one morning and said, I don't want to do business with you, I found someone that will do it cheaper for me? Then now you got 25% of your revenue that you don't know how to get it. So you always want to diversify either your clients or your suppliers, so like that no one has more than 15% of your concentration. Because at the end of the day, that's a big part of your revenue and that's a big part of your operation. If it comes down to you need to start looking for someone else, then it's going to take time before you get there. So, I mean, so your P&L and balance sheet is a very crucial report, because like I mentioned, you could pull that up at any point in time throughout the year and it'll tell you, how your business is operating. You could do it first quarter, second quarter, even on a monthly basis. You could take out your P&L and balance sheet and determine how your business is performing, and where you're going to end up at the end of the year as well. And that's all I have.